Hello and welcome to today's daily educational video here at Forex.Academy. I am your host, Robert Blackwell, and I have the pleasure to walk you through today's daily education. Let us consult the following disclaimer. Of course, there is risk inherent in trading in financial markets. And do, of course, always take into account the inherent risk when trading. And we'll move on to the webinar content of today's daily education. We'll discuss mitigating risk. So all those factors that we can do in terms of moving stop losses, looking across different asset classes to mitigate risk on our account. So let's move forward with the lesson here. We have a very interactive slide we'll go through in a lot of detail just to cover today's quick daily education session. So what we have here in front, of course, is one example where we can look to spread risk across different asset classes. The first thing I'll notice is the asset classes are quite different indeed. We have the German DAX, so the German 30 there. We have the cable market, otherwise known as our pound dollar market, of course. We have the US dollar against the Canadian dollar, another currency pair, albeit with the US dollar as a pair. We have copper as a market, a commodity market, of course. The Euro, Japanese yen, and then the UK FTSE 100. So a good collection of different assets to trade, of course, across 6 different markets that we're looking at throughout this little portfolio here. Now, let's get into actually looking at trading opportunities. Let's say we've taken some of these trades here and we're looking to mitigate risk, natural risk inherent with some of these positions. Okay, so these are our possible entry positions that we've taken across different markets. Okay, so as it stands, really, we have a long entry in the DAX market. Okay, we have a long entry in the US dollar CAD. We have a long entry in the UK FTSE 100, and that's quite some time ago. So we're holding that position for some time, okay? Let's look at our short positions here. Then we're short from today's candlestick. We're fading the high of this candlestick with a short entry there. Then we are shorting this market here, the Euro Yen, and again, just moving down nicely. And again, we have the cable market short from quite some time there, following this trend to the downside. That would suggest, of course, we have a good hedge trade here because we know that the dollar is trading quite strongly at the moment to the upside or appreciating. Of course, we're following that momentum to the downside in the cable market here, shown in this trend. And we're also trying to capitalize this with this little price range here in our dollar CAD. So it's just starting to trade within this consolidation. We're buying in around the levels here, and our stop loss is just below the level, okay? So it's effectively looking for dollar appreciation over the Canadian dollar and possibly trying to capitalize on some momentum in the dollar. But overall, we have a general level of consensus that we have diversification within this trading portfolio. Now, the good thing is, of course, the 2 equity markets that we're in, of course, we have 2 long positions from quite some time ago. So they're trading quite nicely to the upside. We know that the equities are strong at the moment as well. So we have a level of protection there. So let's go through again. I'd like to ask the question, how much risk are we exposed to? Now, we know evidently we have our stop losses in place, but if I walk through, evidently, if all things turn out, to turn around and all things go crazy in the markets, which happens at times, of course, what is our level of risk exposure in terms of a percentage of our account, perhaps? Okay, so let's say we have a €1,000 account, and I'll just draw here on the left-hand side some of this annotation. We have a €1,000 account. We have 6 open trades here, and they're all at 1%. So a 1%, of course, would be effectively on each market here. We effectively have €10 to the downside. Okay, so let's set €60 here for this account. That is our exposure within this account. So effectively, we haven't moved the stop losses in these instances here. We have €10 on the board here, €10 risk exposure, €10 risk exposure. If they're all at 1%, of course, with €10 risk exposure across the board there, okay? Now, how can we look to mitigate this risk? Well, very easily, we'll look to move some stop losses by looking to mitigate some of this risk, take some of this risk off the table. Can we do this? Can we mitigate risk off this table? When in some trades, of course, we can, given we've entered quite some time ago and we're seeing some level of performance there. Should we be able to mitigate those risks? And I'll just like to discuss a possible momentum trade or possible occurrence here in the German DAX. We're long from here. We're long from these prices. Does it make sense to have our entry and stop loss here at these prices, given the market is at highs now? I would argue most certainly not. So we can look to take some of that risk off the table. So let's go through and look to mitigate some of these risks here, and effectively we'll move our stop losses up in 3 different markets here to capture some opportunity, to lock in some profit. Now the question is, guys, what is our new overall level of exposure? What is our level of exposure? Okay, so we discussed 60 euros there at 6% of our account. If they were all 1% trades, what is our level of exposure now in this particular market? Well, let's go through in some detail here. Well, of course, we discussed the first market, the German DAX, is 1%. That's not the case now. So we've effectively we've mitigated not only this 1% away, but effectively we're at a 2-to-1 risk reward here. So let's say we're at 2% plus to the upside with this trade. So effectively we are at 2% in terms of our exposure for that trade, plus 2%. Again, we'll look across our long entries here first. We're flat on this trade, so there's still 1% risk exposure to the downside on this particular market here. With our middle market here, we're short this market again, and the cable market, dollar sterling. So effectively, we have a 1% here, but we've moved and mitigated risk on this trade to effectively 1%. So that's plus 1%. So let me just color code that to a plus 1%. That's great. Then we'll move across to our copper market again. We've just entered that market on today's daily price action, as we can see. So effectively, we have a 1% to the downside there exposed, still ongoing. Our short entry is no different there from fading this move in the euro yen, but we're effectively on side. Could we look to mitigate risk? Again, we're trading just the daily price action, so just not at this moment. And then we have a fantastic trade in the FTSE 100. We entered way down at the lows here. 1% was to the downside. We've effectively caught almost 3.5. Let's call it 3% just for. I'll just remove this here 1 second. Let's call it 3% for discussion purposes on this particular trade. We've effectively captured in a plus 3% there on this trade. So again, the market's up here, but if the market pulls back, we'll get stopped out, unfortunately, with 3% of winners. So that's fantastic. So now, guys, effectively, what exposure? Can we answer this question? What exposure do we have overall on our portfolio? Okay, well, let's count up. We have effectively, if all things turn in reverse and our stop losses are hit in each market, of course, that is unlikely to happen. But we need to know the level of exposure we have, of course. Well, plus 2, plus 1, that's 3. Then we still have open exposure to the downside on that market. That brings us back to plus 2. Then again, with these 2 markets here, brings us back to 1 and 1, 0. Effectively, we've locked in some profit there, mitigating some of those risks, and then plus 3. So evidently from these 6 trades, our risk exposure is effectively plus 3 at nominal level. So if all things reverse, we are effectively looking to gain on our account 30 euros on a 1,000 euro account, or 3% on that account. Now again, as these markets move, guys, we might look to mitigate some more risk and actually take some of that exposure off the table. If we aren't deciding to use these new stop loss levels, of course, that's inevitably not the best strategy, because we are open to the full exposure on account over 6%, but we're also open to losing all of the profit we've well captured in all of those trades. So you can see the variable there, where we had 3% plus risk from the open trade positions and ongoing trade positions. If we had effectively a -6, guys, by not mitigating risk off these trades, you can see that the difference, of course, is 9% on this particular portfolio of risk. So you've effectively looked to capture and mitigate 9% of risk away from opportunity, of course. And as that market continues to hopefully move with you and you look for better opportunities, that gives you the opportunity to do so. Because, guys, of course, you have mitigated those risks away. You're not systemically open to the risks if the markets pull back. You can almost, for some reason, you have your stop loss in place. It allows you to look across other markets for other trading opportunities, and inevitably add a potential 7th market or 8th market to your portfolio of asset classes. Okay, so that's how effectively you look to mitigate risk of your asset class portfolio, and of course look to capture in profit while trading the financial markets. So that brings us to the end of today's daily education. Thank you very much for joining us here at Forex Academy. I'm Robert Blackwell. We'll see you next time. Bye for now.